All right, everyone. In this video, we're going to take a look at problem AP7B in Chapter 4. And this problem has us doing a lot of journal entry work and working in the ledgers, so on and so forth. And so let's get started. And then preparing a trial balance at the end. So, relatively involved problem. So I'm happy to be with you here to walk through this whole process and get you comfortable with how to do journal entries and carry those into the ledger, and then from there prepare the trial balance. So without further ado, let's take a look at our journal entries to start. So the first thing I'm going to do is note that we are working in 2018 essentially in this book. That's kind of the year there, so we're going to have those as that as the year for the dates in the journal entries. And what we have here are the ending balances of the balance sheet at the end of August, and what we're looking at here then will be September. So those will become our beginning balances or opening balances on September before, as we record in our activity in the ledger. So just something to keep in mind there. Okay, so our first journal entry that we want to record is the payment of $1,800 cash for a 1-year insurance policy. So again, that is a prepayment, so a prepaid asset account and a prepaid expense, and in this instance, it's prepaid insurance. Sorry, the inputs are a little bit slow, so. Okay, in this problem too, if you would have watched my last video, you'll note that a little bit of a glitch in the prior problem that made everything formatted were a little funky for the journal entry. So in this one, we're actually able to put it correctly. So note our debits first and credits second, and the credits are indented. And we're paying $1,800 cash and receiving, in essence, 1 year of insurance coverage and that of a prepaid expense asset. And prepaid insurance asset account is 110 and cash is 101. So we'll put in our posting reference numbers there. And then a quick explanation. Paid for a 1-year insurance policy. Okay. On September 2nd, we received cash for services provided. So that's going to be debiting cash. And then, like we just mentioned, that's account 101. And we've got $1,900 in cash. So we're going to debit to increase our cash account. And then we've got the other side of this entry with the revenue to be recorded. So we'll record service revenue. And let's see what service revenue is. Account 400. So we'll put that in. And it was $1,900 earned. And then a little explanation here. Received cash for services. Okay. September 3rd, we paid $1,350 cash for September's rent. So I'm going to go ahead and put rent expense in. And rent expense is account 540. And we pay $1,350. And you know, one thing to note, a lot of times you might see prepaid rent where you're paying up front for multiple months, but this is just 1 month. So it's not a prepayment, it's just paying for this month specifically. Cash is 101. And we're going to reduce our cash by $1,350. We'll put in a quick explanation, paid for rent. And let's look at the next problem. Okay, September 4th, we purchased office supplies on account. So that's important. And when we were booking in our office supplies, let's take a quick look. So we have an asset account here for office supplies, so 115. And we paid $250. And note that we paid it on account. So we didn't pay the cash yet, we bought it on account. So we're going to use accounts payable. And accounts payable is account number 200. And we'll put in our explanation. Okay, September 10th. Here's a little fun journal entry here. It's going to have more than 2 accounts that are affected. So on September 10th, we paid $960 towards a bank loan and $40 of interest. So in this problem, we have interest expense as a portion. And let's see, what is interest expense? It is $520. Account number 520. We've got notes payable, which is our associated liability that we're basically paying down. And that is account number 215. And then we've got, cash. I can't forget that we're actually paying to we're using to pay for the interest expense and the principal payment. So the interest portion was $40. The principal was $960. And then if we add those together, we can see $1,000 cash reduction. Oops, forgot to put the date in there. September 10th. Okay, let's continue on. September 20th was the next one. Received cash from a customer in advance, $2,200. And this was on the 20th. So we received the cash. So we're going to want to debit our cash to note that we did receive it. I'll see that the formatting is funky down here. So, there's a little glitchy stuff with the software like that. It won't let me put it appropriately like it is there, but it's okay. Okay, then we have unearned revenue as our other side of this transaction. That is our liability. So we received the cash, but we have not yet earned it. It's we'll say customer paid a deposit. So we have the cash in our hands or in our bank account, etc., but we have not yet earned it. So we're going to book that now as a liability instead of revenue, which it will be in the future. Okay. Sorry, take a quick break there just to close my door. Okay, on September 22nd, we collected $850 from a customer paying their account. So we received the cash, and that's going to be, that was $850. And then accounts receivable, as they're paying for services previously provided. So our cash goes up and our accounts receivable goes down, which is what we, as business owners, want to see. We want to see that the cash is actually coming in after we do our billings for services provided. Okay, on September 24th is our next transaction. We paid $600 towards our accounts payable. And accounts payable is account 200. And we want to reduce our accounts payable by $600 as it mentions. 101 again. After a while, you get, in real life too, especially, you start to get to know the account numbers by heart for the accounts that have a lot of activity. Paid accounts payable. So our liability has been reduced there by debit, and we're crediting our asset of cash to make that reduce as well. And our final transactions here, the owner withdrew $1,600 cash for personal use on September 30th. And so the account there is titled, the withdrawals account is Lowe's Withdrawals, and it's account number 310. And that was $1,600 withdrawn. And then we're going to credit cash coming out of the business. Not 3, but 101. And we're going to say owner withdrew cash for personal use. Okay, and so this is all of our journal entries here. We have all our debits and credits booked in, explanations, dates, account numbers, so on and so forth. And with that, we want to go in and record all of the activity from, we're going to post from the journal to the ledgers. And so let's go through and we'll start with the cash account, which again is account 101. And then we'll format our I'm going to go through and put the dates in here real quickly. And note that this kind of work is much easier in Excel, for example, or just if you had any actual accounting software, this would all just happen automatically. When you post an entry, it would carry down to a ledger, without you having to actually do this work. But it's good. It gives you a chance to, really practice the mechanics of the whole thing, and how it moves around and the ups and how the ledgers work. So, okay, so a debit normal balance for cash, and like we mentioned previously. Oops, sorry, 1 second. Sorry about that. Okay, so as I mentioned previously, we have the balances for the end of August, and so that will be our beginning balances for September. So let's go down and put these opening balances in. So cash has an opening balance of $7,200. And then from there, with our ledgers, what we want to do is go through, and technically, we'd want to transfer the explanations, the descriptions. So, for example, on September 1st here, we have a payment of cash. So you would technically want to say paid for 1 year insurance policy in that line item, but for the sake of not making this problem extremely long, we're just going to go through and skip the descriptions and put in the debits and credits. That's mostly what I want to show you. And so our first transaction, is a credit to cash. Then on September 2nd, we have a debit to cash. December 3rd, credits. There's a lot of activity in the cash account. So that's all we're doing, is going and taking debits and credits for the cash account specifically. So I'm going to just put these all in here now. Excuse me. And so this is just coming straight off of our journal entries above. Oh, look at a little glitch there. It won't let me input into the right. Oh no, sorry, that's a credit of 1,600. Yeah, a little still kind of glitchy. But okay, and then what we want to do, right? We have a debit balance to start, and then we have a credit, so that's going to reduce. So 7,200 minus 1,800 gives us 5,400. Now 5,400 plus 1,900 gives us 7,300. Then 7,300 minus, because we're crediting, 1,350 gives us 5,950. Drop that down another 1,000. Now add 2,200. And you can kind of probably, oh, this should be a debit, sorry. And again, this is all just coming off the journal entries, you know, so 850 debit, that's just here. The date corresponds to this, so on and so forth. 8,000 minus 600 is 7,400. 7,400 minus 1,600 to end gives us 5,800. And then each one of these will have ending debit balances. So this is the appropriate layout of the ledger for the cash account. And we have an ending balance at September 30 of 5,800. And yeah, and so I'll leave it up to you all here. I'll go real quick here. I'll do this. So we want to label all of our accounts. Prepaid insurance. And so you just go through the list, essentially go down the list of cash, office supplies, equipment, then accounts payable, earned revenue, notes payable, capital, withdrawals. That's one account that you will need to create. That's not in the listing necessarily, so make sure you've got that one. And then you can go to service. Maybe I'll just do that for you guys. That might be just a little tricky. So I'll finish this out for you guys. Office supplies, account number 115. Whoop. Equipment, account number 120. Accounts payable is account 200. Hopefully that's, yeah, there we go. Unearned revenue, it's account 210. Notes payable is account 215. Low capital, so now our equity accounts, and that's account 300. Then low withdrawals is account 310. So that's all our balance sheet accounts, equity and everything. And then we've got service revenues. Now we've got income statement accounts. Insurance expense 515. Interest expense is 520. Office supplies expense is 530. And finally, rent expense is 540. A couple just things to note. I will, you can basically use this kind of, I'll let you all work through the rest of the posting and the journal entries to the ledger. I think that this kind of captures, or I'll do two more just to make sure I'm not leaving you guys confused. That was an asset account, right? So it have very similar asset, with the debits and credits and DR, so on and so forth. Let's look at it. I'll do accounts payable with you all, though, just to give you a reference on a liability. So September 1, our opening balance. So if we look at August 30th, the ending balance was 3,400. So that's our beginning balance the next month. And we put CR here instead of DR because the normal balance and the beginning balance for accounts payable is a credit. And, it's not, I think you guys could probably figure this out. We'll have a lot of practice in class and everything with the kind of the logistics and the flow of these ledgers. But just to remind you, so on September 4th and on September 4th, we credited to increase our accounts payable to 50, and on the 24th, we debited to decrease accounts payable by 600. And so, with that said, how that shows up in the ledger then, on September 4th, like I said, we increased. So 3,400 plus 250 gives us 3,650. And then on the 24th, we made a payment to reduce our accounts payable with $600. Now, with cash being the other side, but the reduction in accounts payable. So 3,650 here minus the 600 leaves us with 3,050 as an ending balance in accounts payable. All credit balances. So just a little different, than an asset account would have the debit, as a debit, and then the debits get reduced by the credits. But in accounts payable, it has a normal balance of a credit. Here we can see this is a credit balance, and we're going to add the credits and subtract the debits. Whereas in an asset account like cash, we're adding the debits, subtracting the credits. So it matters what type of account it is, whether the debit or credit, increases, decreases. Obviously, that's kind of what we've been learning this whole time. So I will do, just looking through the answers just to see if there's any tricky ones. I'll do the withdrawals because there's one difference I want to highlight, and I'll do I'll do the income. I'll do income, and then I'll do one expense as well for you guys, and then let you all fill out the rest. So on the 16th, we had a reduction in, on the 30th, we had a withdrawal. Where is that? There we go. Of $1,600. So we credited cash. That's here, and then we debited our withdrawals account. I said lower. I think it was just low. Last name. Okay. Anyway, just to be completely proper, but the one thing I wanted to highlight as a difference, so one, we only have one transaction, so we don't have to summarize anything or add anything together. It's just a debit, which leaves us with a debit balance in withdrawals. But for the withdrawals account, and then also for all the other income statement accounts of revenues and expenses, there's no opening balance. So that's one key thing to highlight, is that capital, assets, liabilities, and equity, to say basically capital, will all have an opening balance. They carry over. They have an ending balance from the prior month, which is what is shown. If I can get back to it here, those are our opening balances, but you can see there's no income statement, or withdrawals opening balances. Those are temporary accounts that close into equity or capital, which we'll look at that in a future chapter. But just for now, I wanted to make that distinction because that might be a little confusing for you guys. So for now, just keep in mind there's no opening balances for the withdrawals or any of the other income statement accounts, all the revenue and expenses. But we did have some transactions in revenue, for example. So I think we had, just one revenue transaction, it looks like. So on the 2nd, we earned $1,900 and got paid cash. You can see the cash transaction here. So then the other side of that was a credit to revenue. So if I can find my revenue account, 1,900. Again, there's just that one transaction, so it just carries over. There's nothing really to add or subtract from it, and there's no opening balance either. And then the one, I'll just show you just for the heck of it. Let's do a expense account. September 10th, we paid $40 of interest expense. And so that was a debit with the credit to cash being the other side here, we can see, let's find it. I guess it was a summation of $1,000, I think was the date there, if I'm not mistaken. Yeah, September 10th. So I'll just kind of to follow this through. September 10th, paid $1,000. $40 of that was interest expense. $960 was notes payable. So you can see the 1,000 here. I'll show you we'll record the interest expense piece here together, and that's a debit. And then the other debit was a reduction in notes payable. And like I mentioned, I'll let you fill out all this information, the opening balance and the transactions. I'll let you do that for yourself. So hopefully that gives you a pretty good overview of all of the activity. And I'll let you, like I said, I'll let you guys work through the rest of the transactions and doing all that fun stuff. And then I will input for you here the trial balance, so I can kind of show you. September 30th. This is the end of the month. The headers, we have our account. We want debits and credits. And then what we're going to do is just to go up and grab each of the accounts that we have. So you'll want to go through, and every account should be, you should have a line for cash, a line for accounts receivable, a line for prepaid insurance, office supplies, etc. And it's a debit balance in cash as an ending amount there of $5,800. And yeah, I guess I'll put a couple of them in here just to fill this out a little bit for us. So there's cash. So you'll want to put in AR, prepaid insurance, office supplies, equipment. I'll put in accounts payable for you. And the ending balance in accounts payable is a credit balance of $3,050. And again, we calculated that by posting our journal entries. And then yeah, you'll just continue to go through and post the ending balances, debits or credits, depending on where they sit, into the account. You can follow that same listing, starting with cash, accounts receivable, now down to liabilities, accounts payable, unearned revenue, notes payable, capital, withdrawals, revenue, expenses. And then once you have everything in, you'll want to total up all your debits and credit ending balances to make sure that they balance. And I'll give you the totals so you guys can check yourself when you get to the end of the problem to make sure that your debits and credits all add up to it. So both sides of the debits and credits, the total should be $24,640. And if you get those, again, it doesn't necessarily guarantee that you did not make a mistake, but it means that your debits and credits all balanced within the accounts. So yeah, I'll leave it up to you to finish the rest of the general ledger activity and the creation of the trial balance. These are just a couple little pieces of that from the accounts that we actually worked on a little bit. So have at it, and good luck with the problem, and let me know if you have any questions. All right, thanks everybody.